Hi, I'm Mike Hudnall, President and CEO of KMH Global Consulting. From time to time, KMH Global Consulting will be posting informational videos on the state of pension reform, the shift from defined benefit to defined contribution pension schemes, the asset management world globally, the life insurance business, and how industry providers, governments, employers, and individual investors are gathering assets and long-term savings. We will address current issues and discuss best practices from around the world and how you and your company can be successful in participating in this exciting growth market of the future. KMH Global Consulting has over 25 years experience advising governments, industry participants, employers, and individual participants in over 24 countries around the world. So sit back and watch today's presentation. As always, your comments are welcomed at michael@kmhglobalconsulting.com. Good afternoon. Today's talk is about the India retirement and pension situation in 2012. Much of the information in this report comes from the Asian Development Bank study and OECD Pensions at a Glance reports. The India pension market totals $150 billion US today and is expected to grow to US $300 billion by 2019. This is a compounded growth rate of greater than 10% and represents a great opportunity for pension providers to gather assets in this huge market. At present, fewer than 10% of India's citizens are covered by formal retirement benefit programs. As of 2009, the population of India totals 1.2 billion people. By 2050, the projected number of elderly citizens over age 60 will be 19%, and 2.6% of the elderly will be over age 80. 1 in 8 elderly persons in the world lives in India today, 90 million people. This is expected to grow to 200 million people by 2030. Of 450 million workers in India, fewer than 14% are covered by any formal pension or provident fund provision. India is a poor country in terms of per capita income, according to the World Bank, with the average citizen earning only US $950 per year. On average, retirement lasts 20 years, but average life expectancy is expected to rise to OECD country levels in the future. These facts, along with a declining birth rate, constitutes what was years ago dubbed the pension time bomb. So, how is retirement being handled today? Traditional support structures which historically took the place of pensions, such as having children and families, are breaking down due to geographic mobility and domestic worker migration, both inside India and overseas. For example, 5 million Indians work in other South Asia and Gulf countries today. This exacerbates the retirement income problem and forces new solutions to be created to address this situation. There are 3 problems with the current pension situation. 1, very liberal early withdrawal possibilities which lead to early draining of the retirement savings that do exist. 2, lump sum benefit payments, which are very common in Asia, are spent immediately on things other than retirement. And 3, highly conservative investment regulations stifle equity investments in favor of bonds. The India financial sector and securities market is highly developed, but rural workers often have limited access to financial services. Only 37% of the population have access to them. Tax incentives for pension savings are very ineffective because many workers are below the income thresholds. Insurance and annuity markets are still not very mature, and the inefficiencies lead to a subsidy from poor to rich, which must be eliminated. Let's talk about some pension coverage details. As is common in Asia, 30 million civil service workers have a generous defined benefit scheme which is non-contributory. The cost to the taxpayers for this scheme in 2010 was $25 billion US. In 2004, the new pension scheme, NPS, was introduced. This is a mandatory defined contribution scheme regulated by the Pension Fund Regulatory and Development Authority. 2 million central government and state employees are covered by NPS. 20 million large private and public firm employees are covered by a 25% of salary compulsory pension scheme administered by the Employee Provident Fund organization. 60% of their contributions go to a defined contribution provident fund scheme. This provides a lump sum terminal benefit at retirement, but 40% of their contributions go to a defined benefit scheme, which targets a 50% replacement income rate. In this scheme, already, there is a funding gap of US $12 billion in a scheme that was introduced and established in 1995. Other large employers offer a range of privately managed superannuation pension and provident fund arrangements, which are largely unregulated unless the employer wants tax relief for the programs. As mentioned earlier, overall, total retirement assets in private schemes is $150 billion of assets under management. In May 2009, NPS was extended to all citizens on a voluntary basis, which is a good step. Administration was outsourced to the commercial sector. Some features of NPS are very commendable, including portable individual accounts and standard product and fund options. Outreach and service delivery is through 4,000 post office and bank branches. An objective judgment must be, however, that NPS has been a failure, in that only 11,000 voluntary accounts were established by July 30th, 2010. For NPS to achieve success in the voluntary account segment, the following will be needed: much more active promotion, a strong public education program, sound commercial incentives for intermediaries, and much more robust implementation in the field. Perhaps the biggest flaw in NPS is that it doesn't address those that are near retirement age. Again, this is a common situation in the early days of switching to defined contribution pensions. It takes years to gather the assets in these types of accounts. India also does have an old age pension safety net in the form of the Gandhi Old Age Pension. This totals 400 rupees per month per recipient and costs about US $1.3 billion annually. Given that projections on the growth of the ranks of the elderly citizens, this cost, of course, is going to rise exponentially. So, what are the conclusions to be drawn? 1. The situation is being addressed, but not nearly enough has been done yet. Much work and many new ideas will be needed by the government and pension experts alike. 3. The opportunity for the private sector is huge. India pension industry players can learn much from the experiences other countries have had in introducing pension reform. Finally, growth in retirement and long-term savings will not only address the retirement income needs of its citizens, but the growth in these assets will also provide impetus and growth in equity investing and capital market development. Thank you for your attention. I appreciate it, and have a good day.